This webinar focuses on the key determinants of foreign exchange rate. Currency trading is one of the very high growth areas with trillions of dollars of annual trade. In this blog post, I have made an attempt to summarize the key determinants of exchange rate. Number 1. Purchasing power parity. Currencies of countries with lower inflation are expected to appreciate in future. Lower inflation implies lower interest rates, and people will invest at lower rates only when they have positive expectations about future. Number 2, interest rate parity, the international Fisher effect. Put simply and assuming no transaction costs, it says that the spot and forward prices would entail interest rate differential between the two countries. Higher domestic rates countries attract inflow of capital from abroad. Lower interest rate countries have opposite effects. Number 3, current account. The deficit country would demand more foreign currency. Obviously, this excess demand would create downward pressure on the domestic exchange rate. Number 4, terms of trade. It is simply the ratio of exports prices to import prices. If export prices increase by 10% and import prices by 7%, the terms of trade are 3% positive range. This would reflect greater demand for exports and resultantly upward pressure on domestic currency. Number 5, impact of commodities. Currencies of countries like Canada and Australia are heavily linked to the commodity prices. When commodity prices go up, there is an upward pressure on the currency values of these countries. Number 6, economic perception. Perception of economic strength of a country gives vitality to its currency as well.